Hello, welcome back guys. In this video we're gonna be examining PVH Corp, a pretty old company. This one has been requested by one of our subscribers and I think it's an interesting company to examine. You will notice that it has a very high beta. It's actually moving a lot, especially for a retailer selling apparel, of course. And you will see that it has some very well-known brands actually. Tommy Hilfiger, Calvin Klein. This is actually one of my favorite brands personally. So it has a lot of apparel, watches, jewelry, and things of that sort. Very well-known brands behind this one. But let's go back and examine what this company is all about. Now you will see over here, we can take a look at the 5 years chart. Of course, we can also be examining the max chart over here, and you will see that if we go back, if we go back way back actually in time, you will see that for a long while this has been, of course, going higher because you can kind of see the prices here as it's been climbing. But it had a massive uptick over here, and then over here, especially over here, in the past few years when the whole, pretty much the overall market boom has happened, this has boomed as well and has been climbing. Now, again, in this year's, this has been sitting at about 8 to 20 sort of like level, and then in a while it went at some point even over here, as you'll see, there were 158, for example. So insane. But if you take a look at the 5 years chart, it's a story of a company that does move a lot. Like, notice this, it's like almost 160 here, and then it goes back to 40. Going down, up and down quite significantly. This is why it has a high beta. It moves a lot overall compared to the overall market, of course. And being a consumer cyclical company, you can understand these kinds of, down days and up days pretty much, or I should say seasons and periods. But the thing is, are we now at a point in time where it's a potentially good opportunity? Because we are sitting at a low price compared to what it has been doing in the past 5 years. Again, this is like 2018 over here. You will see that it has been much higher. So there seems to be some upticks potentially here for a very cyclical company. Or will it go lower first? Now let's examine the financials, because this is what matters overall. Very low stuff over here, which I love to see, of course. P ratio of about 4 and price to free cash flow of about 5. I like how this converges. This is very important and nice to see. And the company is looking cheap. Now the outstanding shares are also going down. The company is buying back shares, which again makes a ton of sense for a company that has such a low pretty much valuation right now. And so this would make a ton of sense for them to be buying back some of their cheap shares. So they keep buying for a while now. And the company stock price still does go down, so it may give them some extra opportunities. Now, in terms of the total ability to free cash flow, they seem to be having some. We will examine that in a little bit more detail. The little bit worrying thing about the company here is that, okay, they had the slump, for the COVID slump, sure, but they don't grow overall, so they are sitting at a similar level since 2018, which is not great, of course, to see. So when we're talking about companies that are not growing that much, you will expect and you will get this kind of low P ratios and price to free cash flow ratios. Now, this may be too low, but I don't expect it to grow tremendously. It could maybe go like, I don't know, like 8, 10, potentially. At some point, if there is exuberance, it could go higher. Of course, it could even go much higher. But typically speaking, retailers of that sort that don't grow that much don't tend to enjoy, insane valuations. It makes a ton of sense. Now, the net income growth of the company has been overall climbing, again, COVID slump, and the cash flow has also been climbing overall. The total equity growth of the company has been going down, which does make sense. The company has been buying back a lot of shares, so they have been spending some money over here, which is okay. That's totally fine with me. The margins of the company, they are sitting at about 10%, it looks like, over here. And in terms of their return on equity, about 17%, while also they don't have a lot of debt, and very low price to book ratio as well, which is fairly nice to see as well for a company that obviously has quite some infrastructure. Now, the dividend yield over here, sitting at 0.2%, and the free cash flow payout ratio, or a payout ratio by the net income, that is, which is pretty much negligible, is very low though. Like if you take a look at dividend stub that we have here in our tool, you can kind of see that they have been paying pretty much the same dividend. So you know what you're getting, just a little bit of dividend. So basically, practically speaking, this is not really a dividend paying company. Practically, again, very low dividend that doesn't grow. It's just sort of like a tip for investors. So something to bear in mind, but it won't affect your, or it shouldn't really affect your investment decision because it doesn't really extract any money from the company, practically speaking. Now, if we take a look at the financial statements here, you will see that this company is sitting at the same revenue. And again, this is something that I typically don't like to see from companies. Although, you know, having some diversification and some great retailers, maybe one or two potentially, may not be the worst thing of all. Like I would like to have like maybe a couple of retailers that are really, really good and very, very solvent. But you have to be kind of careful and not overdo it with retailers. Don't just take a look at these valuations, see like a super low PE over here of 4 and be like, okay, this is like super cheap, I'm buying. You have to factor everything else, and this includes the key metrics of the company. Not every company is the same, and there's a reason that some companies are more expensive than others. Now, there may be a bad reason, of course. It may be that investors are just like pretty much buying from irrationality, but there is also the reason that seasoned investors do want to be investing in companies that grow, and you know, if you have companies that don't grow, when you want to offload them, it may be much tougher to do. And you know, the stock price could be stagnant for a while. So bear that in mind. Now, it helps that it is lower than what it used to be, though. So this does give us a little bit of a, you know, a potential line in the sand here that can give us make us some money in the process. And also, this moves up surprisingly much for this kind of a company. The bet of the company is very high. It's almost a tradable company. This probably has a lot to do with outstanding shares count, by the way. The fact that they are actually buying back shares and their float keeps going down means that they have less shares to trade in the overall open market, which means that the slightest purchases and sells pretty much affect the overall price of the stock tremendously, quite a lot, because there is less of them. Okay, so let's go back. Let's examine the balance sheet over here. And you will notice that the company's total liabilities over here sitting at about 7 billion, while the stockholders' equity is sitting at 5.2 over here. So the company is increasing the total. Actually, they have been increasing it for a while, but now it's kind of going down a little bit. And then, you know, last year it used to actually went down because I guess, again, this year wasn't great, the COVID thing, and then going back up again, which is nice to see. They seem to be pretty much climbing back to their normalcy pretty soon and pretty quickly over here in FY 2022, as you'll see. And the net income of the company overall doing great, apart from this year, of course, which is the odd one out, and making about $1 billion over here in terms of operating cash flow, which is about what they made in 2020. Again, not really growing much, but pretty much going back to their normal, which at least it's something that's to be expected for the good retailers. And what we do want to see here is the free cash flow, of course, which has been growing, and actually it kind of grew a lot over here, which I like to see. Of course, we can always be examining what caused this kind of increase, and of course this had to do with the 700 million over here compared to $1 billion. But if we take a look at 2 years ago, this was 700 almost here, now it's 800. So there has been a little bit of an increase here. This may have to do with a lot of things, which you could examine here in detail, in terms of you know, what kind of spending the company does over here compared to what they did at this pretty much previous year. They seem to do a little bit more spending, for example, here in inventory, as you'll see, and some other non-cash items. Not much really in terms of a difference, but it does amount to about 800 million in terms of free cash flow, which is about 5 in terms of its price. Remember the price to free cash flow, and you can go back and in our stock analysis metrics here, and see that this is about a 5 because the company is about $4 billion market cap company right now. And again, if we go back to our free cash flow, you will see that they made 800 million, which is about 5 if you multiply. So the other thing that is interesting, the fact that they have a free cash flow of about 800 million over here. Remember that their total liabilities were sitting at about 8 billion, a little bit more than what I would like, but it does seem like it's going down. Now, they did amass quite some, again, the COVID era, but they seem to be actually paying back some of it. And this is actually a good thing to see. I don't want this kind of retailers, especially if I own them, to have a lot of debt. It's different to have a company that's not growing much and have a lot of debt, and especially a retailer. It's not like they're gonna be creating any earth-shaking things really. They're just going by their normal business. So you have to be kind of careful about these companies having a lot of debt. This company doesn't have a lot of debt actually, but it's always worth examining, and the less probably the merrier for these kinds of companies. Now, in our stock evaluation too, we can of course examine what it makes sense to be paying for the company. Now the company did minus 28% and then 28% kind of went back to their normal, and you will see that the revenue growth, of course, because of that, has been affected a lot. But you can kind of judge from the previous years, like 8%, 2%. And again, a retailer that doesn't really grow much, I have to go conservative, and I will go 1, 2, and 3%. And in terms of the net income margins lately, at 10%, the 3-year average has been even worse, but it has been gross because of this. So this is, again, a year that can be easily excluded, and you can kind of examine the previous ones. I will go somewhere in between these values and check what's going on within those. So I'm going to go 5, 7, and 9. I think that makes a ton of sense, frankly, based on the previous years. Again, you can use this very handy little table here to very, very quickly gauge over what the company did in the previous years, and you can use this in your valuation here. Now, the free cash flow margins are sitting at about 60, 80%, not really near 100 in most cases. I'm going to go a little bit lower. I'm going to go 70, 80, and 90 here. It makes more sense based on what I'm seeing. And in terms of annual return, 13% is what I typically ask for. Let's hit calculate. And you will see that we are comfortably within our buying price, even for these pretty conservative valuations here. For this kind of retailers, it's not so much about the evaluation of the cash flow, because they have been hurt. They have been hurt a lot. It's I would say a combination of a decision on whether the business is doing well. Now, we do know that the business doesn't really grow much, but it does make some good money over here. Now, they did have a slump, but they're coming off of COVID and the COVID era pretty much. We are potentially entering an era that could be a little bit worrying for some retailers. So again, you do want to be buying the ones that are very, very solvent, have a lot of money, good money in the bank, little debt. Again, this one is one that has little debt, or at least not much compared to its equity, for instance. But it also has quite some liabilities compared to its free cash flow. So it's kind of a little bit in between. They don't suffer from high dividends, is a good thing. Like, they don't need to be paying back dividends anytime soon. So there's not really a danger of them cutting down on dividends and affecting the stock price. So there could be some upside from here. So I do like the company, but again, I kind of want to edge for some caution, because you want to be careful about how you allocate your portfolio towards many retailers. You don't want to overdo it with retailers. Just try and get maybe the best ones that you have seen in your analysis, maybe getting some help of the videos that I'm making here, but don't go too strongly on retailers just because they're going lower in this at this time, just because this whole stock market is kind of getting decimated for a while now. Don't just see these valuations and be like, okay, this is very low PE, I'm buying. It doesn't work that way. You have to be a little bit more careful. There are always reasons why things are down, even temporarily. And again, there may not be in some cases when there is irrationality, but you don't expect too much irrationality in a company like PVH here, which is like a retailer that is like so old. Frankly, it's not really a trendy company. So be a little bit careful, but if you don't have too many retailers and you want to add some to diversify your portfolio, this actually may be one to potentially add to a portfolio that is, again, naked of retailers or has just a few. But thanks for watching. If you are new around here, remember to subscribe and like this video if you enjoyed this kind of analysis and you want some more in the future. And I'll see you in the next one. Meantime, take a look at this video that I made earlier. And in this one, I'm taking a look at Alibaba and kind of examining the company as a whole and trying to come up with a valuation of what it's worth. Again, similar story to what I'm doing here with PVH. And thank you for watching. I'll see you in the very next one, guys. Bye bye for now.